All right, so Indian equity market have remained volatile since the start of the year. Amidst such volatility, many investors see foreign markets such as that in the US to diversify their investments. So should you think about investing in the US equities? How can investors capitalize on currency hedge? Let's answer all of these questions with Kaustubh Belapurkar, Director Fund Research, Morningstar Investment Advisor India. Kaustubh, good evening and welcome to the show, and we are going to explore all the angles of investing in the US market, specifically to diversify or to add that touch of diversification in your portfolio. So currently, just explain us how exactly are the US equity market placed?
Yeah. So Kavita, I think that we're having this conversation at a very good juncture. Obviously, I think we've been very strong proponents of international diversification. And let me just quickly, to address your question about, where the US market's placed, right? So there have obviously been, headwinds for the US markets, given, where, the economy is headed, with inflation concerns, Fed hiking aggressively. But what we've seen in the past 1 year that, in 2022, especially calendar year 22, there was a sharp drop in the US equity markets. And obviously, relative, the Indian equity markets did outperform. In the last 3 months, the first 3 months of 2023, there has been a recovery in the US markets, especially on the technology, some of the communication, media, entertainment names. But, that valuation gap still exists. So I think broadly, the US markets are obviously poised at a very interesting juncture there are clearly some headwinds in the short term. But, I think the overall thesis when we think about investing in a market like the US, that still remains intact over the long term. And, we can kind of discuss that through the show.
Kaustubh, also explain us, when we talk about international exposure to your portfolio or maybe diversification of that type, why should we consider only US markets at the current juncture?
So I wouldn't say it's necessarily a case only for the US markets. But, when you think about just the options that are available to an Indian investor right now, especially through a India domiciled fund route, a majority of them are sort of US based. That's one, obviously. And I think secondly, US markets being the world's largest economy, being home to, some of the largest corporations, global corporations, the most innovative corporations around, definitely makes a compelling case to have allocations towards US equities. You can definitely look at other markets across the globe, but I think US markets definitely, from a long-term perspective, an Indian equity investor should be looking to allocate some of his or her capital towards that. And let me just outline some of the reasons that I kind of alluded to, right? So, like I said, some of the largest corporations in the world that reside in India, in the US. And remember that these are corporations that don't have business only in the US. They have businesses all across the globe. And, if I just give you some quick stats, and everyone talks about these global corporations, which is some quick stats around when you look at the large benchmark indices, be it the NASDAQ 100 or the S&P 500. From the NASDAQ, only about 50% of the total revenue of the NASDAQ 100 companies actually comes from the US, right? The remaining comes from outside the US, so truly global, and, even in their revenue spread. So you're getting exposure to a corporation that has revenues coming from all across the globe. In fact, India accounts for about 1.5% of the overall sort of revenue coming in for the NASDAQ 100 companies. Similar stats to the S&P 500, probably slightly more, US centric given the spread of the companies that are available. About 60% comes from US revenues, but the remaining 40 comes from outside, and about 1.5% again coming from India. So I think these are all brands and companies of which products and services we are very well acquainted with, right? So why not participate in the growth of these companies, which are really leading edge, cutting edge in terms of their innovation and coming in products and services, which an Indian investor otherwise would not have access to necessarily from a local market context. So I think that adds a lot of value to your portfolio, in terms of, so we speak about diversification. Here's a diversification that, can happen in terms of company type, product type, obviously geographical diversification, because the other thing that, has played out in the past, if you just look at calendar year returns of say Indian equities versus, US equities and some of the other international markets, they always work in tandem, right? So there'll be years where Indian equities, for instance, 2022 was a classic case in point where Indian equities did relatively much better than US equities. But if I just take it back in time to, the years of 2019, 2021, especially 19 and 20, US equities significantly outperformed Indian equities, right? So you need to be invested in those markets to make the most of it when the run up happens again. And that's where you can really aid in diversifying your portfolio, not just typically by asset class or by market capitalization, but by geography of the businesses that you're kind of investing in.
Sure. So this diversification should be like a broad-based diversification, or we can also take a thematic route when it comes to international exposure and specifically US equities.
Yeah, I would think I would lean towards taking a more broad-based diversification. For most investors, that would probably be the ideal route. So typically your more broader indices would, have a good representation of the largest companies, like I said, which are US domiciled, but, have operations all across the globe, right? So, and there are two primary indices that, people track. Obviously, there's the NASDAQ 100, which is typically overweighted more towards sort of the technology communication services names, so it doesn't have any financials exposure. Or you have your S&P 500, which also includes your financial exposure within that broad-based so these are the two broad US indices that investors can look at. And obviously, there are options available to them across both of these. I think thematics would only be useful for an investor who wants to express a certain view, that who's very, very positive, say, on a certain set of stocks, or more pro value or growth. If you want to do a style-based diversification, would look to expose themselves to that. Otherwise, I think a broad-based would work best for most investors.
How can one capitalize on the currency hedge here?
So, this is something that people, do kind of replicate. So remember, your investments, when you're eventually, you're investing in a fund, while it's rupee denominated, the end investment that the fund is making is either into, US stocks or a US based ETF or a fund, which is obviously US denominated, right? And essentially what happens is, your end investment is actually US dollar denominated. And, given traditionally, we've obviously been, high growth, high inflationary economy with higher interest rates. The rupee has depreciated against the US dollar, and obviously, as US inflation and interest rates kind of normalize over the years, the rupee could tend to, that's what macroeconomics suggests, to continue to kind of, depreciate versus the US dollar. So what that does is then will essentially allow you to take a US dollar exposure, which could also help you in kind of getting some currency appreciation. While that's not the primary motive, but a lot of people, say, for instance, have goals for their children or whatever to say study overseas, and we've all faced the brunt of it, that costs of education are going up. With a depreciating rupee, the cost of education get exacerbated even more. Here is an investment where, not only will it benefit from the fundamentals of the US economy, but also perhaps, just from the rupee depreciation that could play out in the coming years.
One question, that's coming on my mind is, since we all know that in a globalized world, economies are really connected with each other. So when we talk about international diversification, is it really diversification in its true sense? And for that matter, US equities?
Yeah, absolutely. So I think that's a very good point, Kavita, because, we always imagine that, we are one global pool of assets, and, that's how economies are definitely going to be, kind of not necessarily moving in tandem, but taking a cue from each other. But markets always can move in dissonance, right? And that's actually what we've seen in the past, and we expect that to continue to play out. And if you just look at, and we've, for convenience, we've kind of broken it down into, say, calendar year returns of the broader Indian indices versus the two frontline US indices that we spoke about. And we've seen pockets of time, I alluded to that in the earlier sort of discussion also, that 2019 and 20 were great years for the US, sort of markets versus relatively to the Indian markets, right? In fact, 2020 is a specific case in point where the tech stocks did exceedingly well. The NASDAQ 100 was almost up 50% versus maybe about 16 to 20% for the Indian indices. The S&P 500, probably not so much. It was only up about 18, 20%. But 2019, we had both of these indices up between 30 to 40%, whereas the local markets were only up 10, 12%, right? We know that changed in 2022. We've seen this in the past also. 2013, let me take you back 10 years. 2013 was another classic case in point where the dispersion of returns was massive between the Indian markets and the US markets. The US markets both these indices were 30% plus for that calendar year in 2013, whereas the local Indian markets were in single digits, about 6 to 7%. And this completely flipped in 2014, where, obviously post the election results, the Indian markets ran up, while the US markets posted reasonable returns of high teens. The Indian markets are about 35-40% up, right? So this interplay of market movement continues to happen, obviously depending on where people see valuations. If a market's relatively undervalued, can move up. So I think definitely that aids in diversification if you're buying asset classes, which on a long-term basis could potentially be correlated, but the short-term movements can kind of help pad your returns and give a lot lesser volatility on an overall portfolio construct when, if one equity asset class is not moving, the others relatively doing better.
And here is the question, which is related with the US vulnerability of recession, So why invest in such an economy after all? We are one of the fastest growing economies in the world. And for international exposure, why choose an economy that is vulnerable and that has a risk of recession also? Especially in the near term outlook. Obviously, when you are making a portfolio and you are adding diversification of a concerned geography, but then you really need to understand the kind of phases that economy is going through and need to be very specific, with your entry timing. I think you've mentioned this earlier also in your answers that this is the time when you can. Do you think the valuations are really right, looking at the risk which is still ongoing? What kind of exposure to start off with you can and maybe increase it later on, as the risk fades?
Sure. I think that's a very valid question, Kavita. And I think let me address this through a couple of pointers, right? So one is, you're right. I mean, there are some short-term pains with regards to the US economy. Obviously, there's the looming recession that could potentially come, the inflation, that they haven't seen for so many decades, and obviously the Fed's being aggressive in their rate hikes. There's the oil price, and being spoken about that oil prices are moving upwards given the OPEC production cut, which could also have an overhang on the inflation. All of these short-term problems do exist with the economy, which could potentially, be an overhang in the short term. But, just going back to my earlier point about when we think about the US markets, while they could be companies that are operating out of the US, these are truly global businesses, right? So, I mean, if you're looking at the NASDAQ 100, only 50% of the revenues are actually coming from the US and the remaining from outside, the geographies. And you're getting exposure to companies which otherwise you wouldn't necessarily have exposure to from an Indian perspective. And, we're, like I said, we're all users of this. So, for instance, if you're using a computer, you're either on a Windows computer or a MacBook, right? And these are two of the largest listed corporations on the US indices. We all use Google, we all use Facebook, there are a lot of us using Netflix. So I think these are all corporations that, while present in the US, have a lot of corporations or revenues coming from outside. So in that sense, at least to a certain extent or to a large extent, they're not completely dependent only on the US economy to drive their revenues, right? So I think that's a very important thing to keep in mind. And the exposure that you're getting to this economy, which otherwise, like I said, you wouldn't be available to you necessarily from an Indian context. In terms of timing, obviously we talk about valuations, and like we said that US stocks or the markets have been in the undervalued zone for about the last 6-9 months. Since the large part of 2022, because of the steep correction that happened in the markets, especially on the tech stocks in the year of 2022. Some of this undervaluation has gone away simply because, there's been a reasonable run up in these stocks in the past 3 months. But, I wouldn't think of that only as the trigger to move in, because I think timing can be fraught with a lot of timing risks in terms of trying to just chase valuations and come in. The compelling argument is buying these businesses, buying the diversification benefits, getting exposure to companies that you cannot otherwise get. And that's why the best route for any investor, we always recommend it, come in systematically. I know there are challenges in terms of, which funds are open, which are that. So that's something investors will need to figure out with their advisors. But definitely come in systematically and probably add, about 10% of your equity portfolio to international funds. I would say a large part through US funds would definitely add, great sort of diversification and return benefits over the long term to your portfolio.
What about the choice of index? S&P 500 and Nasdaq 100 clearly have the largest corporates in the nation and also have a fair, strong value proposition here. But then there are other choices of indices as well. How can one decide?
Yeah, so I would say just try to think about where you want to be leaning towards your exposure, and there is no right or wrong answer, to be honest, because these are two very, very broad and well-tracked indices. So I would actually be indifferent between both of them, the Nasdaq 100 and the S&P. Obviously, I think one thing we must acknowledge with the Nasdaq, it is tech heavy. It does have for instance, your top five would account for more than 40%. So it is a little kind of concentrated in the sense in terms of the top names really weighing on the.
For Indians to invest in the US markets, should there be direct investment strategies, or one should be going through AMCs? And as you earlier mentioned also, one should be going through funds and having the SIP route, which is safer for them.
Yeah, I would definitely do an SIP through the funds that we have domiciled in India. It's the cleanest is the easiest way of doing it. Obviously the other option of doing the LRS, which is it is a very operationally hassling tool. So obviously subject to which fund they're open right now, given the caps that are in place. I'm given to understand quite a few of these are currently open, so investors can evaluate which exposure they want to take and definitely do an SIP in those funds.
At the funds return, okay, last 1 year looks really negative, but then the returns before that really make them hard to ignore. So what should be the placement? How much should be the exposure? Suppose if one is supposed to be entering this market through maybe a fund of fund or an ETF, what should be the exposure like in the portfolio?
Yeah, I would say maybe about 10% of your overall equity exposure you want to add and do that systematically. And like you said, the near-term returns haven't been great, and that's probably the right time, to get in, right? Because like I give the example of 2013 and 14, what we saw was we had this significant run-up in U.S. stocks, the markets in 2013. A lot of money came into U.S. funds in 2014 after the run-up had already happened, and then people went overboard. Invested a lot of money into US funds, and that's when the tide turned and Indian equity started doing well, right? So we want to avoid that chasing of recent performance, rather just systematically decide that, look, I want to invest an X%, which is typically I would say 10% is a prudent sort of number to start with for your portfolio. Put that SIP in place into US markets. Don't worry so much that is the valuation in the fair zone or slightly overvalued or undervalued. Let kind of time be the best friend for you in markets like these.
Now, despite the shifting tax landscape, how attractive do you think are international funds even now, and what all one really needs to take care of?
Yeah, so that's, I think diversification benefits still remain a very compelling choice. Yeah, obviously tax has changed and, there's nothing that we can really do about it. And my advice to investors would clearly be that, go on the merits of the product, not necessarily, what the taxation is, because we've seen that, tax laws can change at any point of time. So, we shouldn't really be basing our decision purely on what the taxation is. Obviously, it does weigh on your decision, but, the merit of the product would be the predominant deciding factor. And definitely, like I outlined in the discussion, there are enough merits to make an investment in US equities.
All right. I think we've addressed all the questions related to investment in US equities for our viewers. Thank you so much, Costa, for being on the show and helping our viewers with that. On that note, we'll take a quick break, and after that, let's talk about SEBI's rule on PMS cybersecurity and how are your investments safe with all the fund houses. All of this and more after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Now, recently, capital market regulators SEBI issued cybersecurity and cyber resilience framework for portfolio managers with an AUM of Rs 3,000 crore or more. To understand more about these guidelines and how they will impact portfolio managers, let's bring on board Gautam Kalia, Senior Vice President and Head Super Investor at Sharekhan by BNP Paribas, Ritesh Bhatia, Cybercrime Investigator, and V4 Web Cybersecurity Founder. Good evening and welcome both of you. So, Gautam, I'm going to start with you because we really need to understand this framework that the regulator has set for PMS fund managers. What exactly do they mean by having a stronger and much more resilient cyber framework?
Yeah, sure, Kavita. So basically, in about March 2021, the regulator came out with a BCP plan circular, making sure that business continuity should be managed during different events. So, for example, if there's a terrorist attack or an earthquake. So now cybersecurity is also becoming extremely important. There's if you just look at statistics around cybersecurity, there are some estimates suggest that there are like 10 to 20 attacks per second worldwide, or the cost is in the hundreds of billions when it comes to, let's say, ransomware attacks. So there's a lot to do with data security and data privacy. So that's where the regulator is stepping in and making sure that large PMS providers who have more than 3,000 crores do have a plan in place to prevent such attacks. And if, let's say, they do become the victim of such an attack, they have plan B and contingencies in place to address that and make sure that the system still continues to support the investors. And that's really the core job of the regulators. So I think it's fantastic that the regulators taking the step and making sure that they are making the entire system in India robust through this framework.
Also, SEBI has laid down timelines to notify cyber attacks and has also asked portfolio managers to submit quarterly reports on that also. So that's really an active charge on this matter. But then, Ritesh, to understand what's currently happening, what all can you tell us? Because it's not that we're not just talking about the PMS fund managers or those AMCs, of more than rupees 3,000 crore AUM. But then what about the current status of AMCs and having a robust cybersecurity infra for their investors?
Yeah, so thanks, Kavita, for having me on the show. Kavita, I think overall, if you look at the BFSI sector and including the insurance and AMCs and securities, banks, everybody, the structure is quite robust. The issue is actually at the third parties end because, I'm on the technology committee of several AMCs and other BFSI companies. And I really see that a lot of emphasis is given on data protection and data privacy both. But if you look at, when it is being outsourced to those third parties, now the third parties are the biggest risk. Few days back, you must have read in the news that, so much of data, like almost half the population of the countries, there's been a data theft. Now, why is the data theft? Because there was so much of data, especially from the BFSI sector, which is like generally outsourced to the third parties. And from there, it has been sold as such. So even if we look at the SEBI's policies right now also, it talks about encouraging these third parties also to have a very robust framework. So overall, if you ask me, yes, these AMCs and other people in the BFSI sector, I think the infrastructure is robust. And I must also thank like these regulators, such as SEBI, RBI and all, who actually keep a good watch on these things. And this is not just one, they have, there are several such circulars and it's been there since quite a long. And even if you see this one, which came on the 29th March, it has got like 55 controls it is talking about. And, some of them are pretty good, like, focus more on awareness on the non-tech employees. Now, that was my personal favorite because generally we talk about, just having an awareness session for everyone. But here we are seeing the risks, what are there. Secondly, what I really liked over here is that now SEBI is trying to say that, listen, some of your assets, you need to identify them and need to call them as a protected system, which means now these AMCs, certain assets of AMCs will become a part of the critical infrastructure. And because of that, they will have to they'll have to put a lot many controls, and the security is only going to get better. Kavita.
Exactly. Gautam, taking what Ritesh only said ahead, do you think this will also come on the other AMCs right now? We're just talking about PMS, but then what about the rest of them?
Yes, I think it's only a matter of time. So a lot of distributors and referral partners of AMCs and PMS providers, manufacturers, they already have a due diligence process where they ask such questions of these providers. So it's going to be pressure from all sides, So For example, at Sharekhan also we only partner with people who kind of meet certain criteria, and those criteria include such commitments and such tight policies around the BCP as well as cybersecurity. So it's just a matter of time before everyone has to step their game up and make sure that they are prepared for this, because you can't have an excuse, let's say when it comes to investments, that we were attacked and there's a ransomware, so suddenly you can't access your money. So obviously those kind of issues no one wants to deal with, or no one wants to have their clients exposed to that kind of risk.
Exactly. Even though, Ritesh, you mentioned that our AMCs have a robust cybersecurity framework already installed, how can an investor still be sure that wherever they are transacting online, especially, they are well within their controls and will not fall prey to any sort of cyber hacks or anything where they can become a victim of these frauds?
Users and they just bookmark these AMCs where they are investing. So suppose if they're doing it through Sharekhan, just for example, because the co-panel is from Sharekhan, then you have the website bookmarked, because tomorrow there can be like a spoof website of Sharekhan, and there you go, enter your credentials, and using those credentials, then he will actually go to the main Sharekhan website and try to do all those things. So probably it is the same old thing that that please verify whatever you're getting. So even if it's an email, where it says, okay, it looks like your account has been breached, please click over here to enter. I think investors should go and verify it. Everything will boil down to verification. This is the only tool that they need, and they need to download it in their minds. And other thing is if you have any particular grievance, don't just trust what you see over there. I mean, if what your search engine shows you, it is quite possible that the numbers that are coming over there of the customer care and all, they can be wrong. So at that point of time, it's important you go to the actual website and speak to the right person through the contact us page. Kavita.
Ritesh, what if you're a victim? What all can be done?
Oh, well, if you're a victim, the first thing I think is immediately call up 193. So that's the most important thing. Don't delete an evidence. That is another thing, because most of the times victims delete and then they say, okay, we don't have any evidence left. So call up 1930, file an official complaint on the National Cybercrime Reporting Portal, which is www.cybercrime.gov.in. That particular complaint will go to a particular police station, and then you will be called to the police station. And then in case if you think, matters are not being resolved, then you can approach the RBI or the SEBIs, the grievance officers, the nodal officers who are there.
All right. So I think a lot has already been done, but then still there is scope of a lot of things that needs to be done, especially when it comes to the awareness and investor awareness on this particular topic is very important. Thank you so much, Ritesh, for being on the show. Gautam, you please stay on with us, because we will slip into a short break now, and post that we'll be taking up viewer queries. So just in case, even if you have your portfolio related question, you can WhatsApp that question to us, or you can also email it on themoneyshow@etnow.tv. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. There are plethora of funds available in the market to invest your hard-earned money, but how do you assess which is the right fund for your portfolio? What are the criteria that one should look at to help you navigate through all of this? We have on board Gautam Kalia, and just in case you want to send us your portfolio queries, you can WhatsApp it on 865-797-4571. You can also email us your queries on the Money Show at etnow.tv. So Gautam, we have the first viewer online with us, Kiran from Pune. Kiran, hi, good evening. How are you?
Hi, good evening. Yeah, I'm good.
What do you do professionally, Kiran?
I'm working in the private sector.
All right. So you want to start investing in mutual funds, is it?
Yes.
Okay. Before that, you've not invested anywhere in the markets directly, or you have any other investments? Nothing at all?
No, nothing.
Can I know your age?
33.
All right. So you want to invest specifically for 10 years. Any specific goal, financial requirement that's coming up in 10 years?
Nothing but like the excess funds, I wish to invest somewhere to get the greater gains.
Okay, so I'll just take your goal as wealth creation in 10 years. Right now, you can invest 20,000.
Yes.
That's right? Okay, any particular corpus that you want to achieve in 10 years? Nothing of that sort?
Nothing. But the greater will be good, like that.
All right. Thank you so much for trusting us with your investment journey. You are investing first time. So, Gautam, there's a lot that you might want to tell Kiran, but given the time constraints we have, what will be your suggestion?
So, Kiran, first of all, congratulations for at least deciding to take this step. Hope you'll take the step. There's a lot of discussion, debate that happens within the mind and with friends and family before people actually start investing. But actually taking the step, then just it kind of snowballs and then gets you going. Success leads to more investments. So I'll just quickly tell you what I think you can do. One of the things you can do is you can start with a portfolio which has a little bit of equity and some debt. So you can put in about 8,000 rupees in Mere Asset Large Cap Fund, 6,000 rupees in HDFC Large and Mid Cap Fund, and about 6,000 in a dynamic asset allocation product like ICICI Prudential Balanced Advantage Fund. So if you start with these funds, you'll get a little bit of stability because of the debt allocation in ICICI Prudential Balanced Advantage Fund. And you'll get more bias and focus towards the large and large mid space in equity through the other two schemes. So this will total to about 20,000. Just keep in mind, please stick to this journey. You're only beginning. The longer you stay invested, the better it is for you. So if you have that 10-year horizon in mind, fantastic. But the key is to stick to it. The funds can change. One fund can be replaced with another fund over time. But as long as you stay invested in the asset class, that's when you are able to see the benefit of compounding returns.
Gautam, also you might want to stress on having a specific financial goal. I mean, we don't know what's his current status in life, but as you grow, you might have financial responsibility. Your income also might go up, but then it's very important for an investor to align the right kind of financial goals, or at least the necessary ones that you might just see coming up in future.
Yeah. So financial goal, while it's excellent to kind of have a plan saying, okay, this money will be allocated for, let's say, house purchase, or for my retirement, or for my child's education, or for, let's say, buying a car or anything like that. The key advantage of actually having a financial goal tagged to any of your investment is that then you don't deviate from that plan. Right, because then you are able to resist the temptation of other investment opportunities that may come your way, that may derail you from the plan that you put in place. So it kind of reinforces, okay, I've got this plan, I need to hit this number, and I'm not going to let this plan get impacted for that new exciting new investment opportunity that you may come across maybe 3 years, 4 years from now. For that, you keep a separate allocation. So really, that's what helps you when you start off. And I would suggest that you talk to a distributor or an advisor and get a in-depth financial plan made for yourself.
Maybe you can send us your question once again. So there's a large cap fund recommendation to you, large and mid cap, and a balanced advantage fund. Thank you so much, Kiran, for sending us your query. We have Mr. Sushil Kumar Bhatia online from Delhi. Hello, Mr. Bhatia. Good evening. How are you doing, sir?
Good evening. Fine. Thank you for taking the question.
Thank you so much for sending us your query. You have ICICI Pru Blue Chip, you have a flexi cap from the same AMC and a multi cap from same AMC, and you might have your savings bank account also in the same AMC, is it?
Yes.
All right. So you don't like these funds anymore? You're not happy with the performance?
No. I'll tell you, I invested lump sum around 50,000 in flexi cap, but that has only given me 5% return in flexi, ICICI Pro flexi cap. And large cap, that is blue chip, has not given me more than 10%.
Okay. All right.
I've been investing regularly for almost now 3 years in blue chip. So I want to know whether my fund selection is correct or whether I should go to some other funds.
Okay. You don't see any problem of having 3 funds from the same AMC, sir?
That is because the convenience that they are helping me in making the SIP. That is because of the convenience I am using same fund. Otherwise, if any other fund house does the same for me, I am happy to go with them.
All right. So even if you're investing in some other funds, it is as convenient as it is in the funds where you have a savings bank account already. So it's just a matter of convenience over here, Gautam. There's no such other logic why he's picked up the same funds from one AMC. But apart from that, what is the problem in having just one AMC funds in your portfolio when you talk about the philosophy of an AMC or the kind of positioning they have? How does it impact the fund strategy or maybe the way funds want to work or allocate their exposure?
Right. So, Kavita, basically, while AMCs strive to have a variety of styles and different fund managers have their own approaches to managing money across fund styles and fund categories, and you can see here like blue chip operates in a separate segment compared to, let's say, a flexi cap, because flexi cap can go into large, mid, and small, and the fund managers are also different at times. What happens is you don't get access to completely different styles of approaches, or let's say best practices that other established fund houses may also offer. And sometimes you can end up with like a group think, though there are enough checks and balances in place within most of the large AMCs to make sure that whatever the top ideas are, they are allocated to appropriately in different funds. So they understand that, okay, this idea is more suitable for this specific fund A, and this idea is more suitable to fund B. So while they try to create that differentiation, it's always better for an investor to have a little bit more diversification in the basket to get exposure to different, completely different approaches and philosophies within, across fund houses. And that's what my suggestion would be to Mr. Bhatia, that maybe you can look at diversifying the portfolio. Having said that, I just want to first preface that your experience of a 3-year SIP return being 5%, 6% is pretty much in line with most SIP investors who've not really seen much returns, maybe high single-digit returns or low double-digit returns at best over the last 3 years, because the underlying market or that segment, that large cap segment or the small cap segment really hasn't delivered significantly. So that's the reality of the market. You're sitting on a point-to-point basis. If you look at performance, last 3 years haven't really been that great in terms of overall returns. So you would have had that same experience had you, if you had diversified already. But given that going forward, still I would suggest that you look to diversify. What you can do is move your ICICI Prudential Flexi Cap to HDFC Flexi Cap, and the ICICI Prudential Multi Cap to the Kotak Emerging Equity Fund. So that way you have diversification across different fund houses as well, along with fund managers.
All right. Mr. Bhatia, anything else you want to ask?
No, I want to ask is that whether balance advantage fund will give better return as compared to flexi cap?
Okay. So balance advantage fund by its very nature will have a debt allocation to it. So there will be more stability, and with debt yields high historically, relatively now, you'll get maybe a 6-7% yield from the debt allocation as well. So there is a little bit more stability. But if the market rallies from here, then the market movement capture will happen more with a flexi cap fund. So if your investment horizon is more than 5 years, then you should look at staying invested more in equity. So that's why you should, my suggestion would be that you stay more invested in like a flexi cap over a balance advantage fund, which is a little bit more of a defensive play. That defensive play will yield you more stable returns, but the expected return is lower than a flexi cap.
Thank you, Mr. Bhatia, for sending us your question today. All the best with your investments going ahead. Gautam, we will take the question of Swapnil Mohapatra, and he says that he wants you to suggest some good index funds.
Right. Swapnil, I'm sure you know that index funds are passive in nature, and they try to mirror the underlying benchmark, which is the index. So what you should be looking at is like a low tracking error of the fund and a low cost of the fund versus the benchmark. I'll give you a couple of names that you can consider. One is the Nippon India Index Fund Nifty 50 Plan, and the other is the SBI Nifty Next 50 Index Plan. So these two you can consider. I think gradually I'm seeing a lot of clients, a lot of investors also saying that last 3 years not really made that much return. Maybe if I go for low cost funds, I'll probably be able to save some cost, and that will yield to higher returns. But in the process, they sometimes also end up missing the forest for the trees, because active management can yield alpha. And if your fund selection is good and consistent, you can actually beat the benchmark at a portfolio level consistently.
All right, we move on to our next viewer, and we have Subhash Shahani's question. He says that he's a senior citizen, 76 years old, and he's investing via STP in the funds which he's mentioned: ICICI Balance Advantage, Kotak Balance Advantage, ABSL Balance Advantage, Mira Asset Blue Chip, Mira Asset Tax Saver, Canara Robeco Emerging Equity, and SBI Focused. Now, exactly what he wants to know from you is, how are these funds? And it's the STP of 10,000 rupees that he is doing. We don't have him on the phone line. Otherwise, I would wanted to know as to what is the intention of this portfolio, Gautam. But how can you guide him?
Yeah, so Mr. Sahni is basically asking whether his portfolio is okay. Does he need to make any changes in the schemes? So Mr. Sahni, your portfolio is fine. I think maybe just one change that I would suggest. It's not a major change, but you could consider it, which is looking at moving away from SBI focused into another dynamic asset allocation, because basically your age. So you could look at moving SBI focus scheme to, let's say, shift to like a ICICI Prudential Balance Advantage Fund. And the reason why I'm saying that is only because of your age, and at that age, maybe you want to look at a more defensive portfolio. So basically increasing the defensiveness of the portfolio. If that is more comfortable to you, you should consider that.
Okay.
But otherwise, schemes are fine.
All right, we move on. Anand Kumar from Delhi, and right now he's investing in Axis Small Cap and Kotak Emerging Equity, 3,000 each since last 5 years, and these are the only two funds he has in his portfolio. Again, we don't have him on the phone line, so we don't exactly know what's the time horizon or what are his financial goals. But what do you think? He needs a balanced portfolio. Can that be done?
Yes, so Mr. Kumar has exposure only to small cap and mid cap. This is what information I have in front. Maybe he's got some large cap, but really, if he's only got these two funds, then he's investing only in small and mid cap. So he needs to have more exposure to large cap as well to kind of round out his portfolio. So my suggestion would be that he shifts out of the 3,000 rupees per month that he's putting in Axis Small Cap, maybe shift only 2,000 rupees to the large cap scheme of ICICI Prudential Blue Chip Fund, and from the 3,000 that he's putting in Kotak Emerging Equity, move 2,000 of that to the large cap, the flexi cap scheme of HDFC Flexi Cap. So what happens is that way he's adding a little bit more large cap bias to his portfolio, which currently is non-existent, and gradually commit more amount overall to his portfolio, because finally it should be a meaningful goal that he's trying to achieve through this investment. So 6,000 rupees will probably not yield that kind of corpus unless it's for a fairly long period of time.
Gautam, last question to you is from Prem Kumar, and he's investing again in one AMC's funds: Axis Blue Chip, Axis Small Cap, Axis Mid Cap, and he's been investing since last 2 years, and time horizon is 10 to 15 years, although we are not aware of the corpus, but then total 30,000 SIP that he's doing.
So Mr. Kumar has put in his request that he wants to plan for his retirement, and that's why he's doing this. So that's fantastic that there is a goal associated with his investment. Again, all schemes from a fund house, there is always this risk of groupthink or same fund manager style, or overlapping of stock ideas. So to ensure that there is more allocation, more diversification across AMCs, as well as a little bit of more allocation change, because there's a significant allocation here to large cap. There's almost 70% of his allocation happening to large cap, with 20,000 rupees going in Axis Blue Chip out of 30. So suggestion is that shift 3,000 rupees per month SIP to the focus scheme of Mire Asset Focus Fund, and 6,000 to the value fund of ICICI Prudential Value Discovery. So you get instead of just the GAR, growth at reasonable price strategy, which most of these funds are following, you get a value style investment also, diversified option within the portfolio. And remaining, you can move to the large cap scheme of Kotak Blue Chip Fund. So these are the three funds that you can move that 20,000 allocation to. And the Axis Small Cap can be switched to the SBI Small Cap Fund because of fund selection reasons. So that fund we prefer basis our research. Axis Mid Cap, please continue.
So now also one thing, Gautam, because see, he's got a good amount of investment, he's got 30,000, and to divide that, right now the strategy is of 3 funds. I mean, you've added more, but then can we have like 4 to 6 funds for the amount of 30,000 in your portfolio?
So that's a very interesting question, Kavita, because because when okay, so I differ a little bit from most advisors here, people from the industry, because it all depends on the overall wealth of the individual. So if the overall wealth of the individual is, let's say, 10 crores and he's putting in 5 lakhs a month in SIP, he can have a concentrated portfolio of 3 funds. He doesn't need to have a diversified portfolio of 15 funds or over-diversified portfolio of 15 funds. Similarly, if someone is earning 1 lakh, 30,000 rupees is a fairly large sum, to put in SIP. So I think it's all relative, and it boils down to the specific situation as to the number of funds. And it's generally a consultative process, but I prefer not to go beyond 8 to 10 funds. I think 10 is probably the outer limit, and not because of the reason that most people talk about, which is over diversification. I think it just becomes tougher to manage and track performance when you have so many funds. It's fairly easier to have a concentrated portfolio, maybe 6 to 7 funds at best, regardless of your overall wealth.
Gautam, that will be all. Thank you so much for removing time and helping our viewers with their financial portfolio. On that note, it's a sign off from me also, but then I'm going to leave you with our WhatsApp number and our email ID, where we keep waiting for your questions and we get your financial planning done live from our experts on the show. Thank you so much for watching. Goodbye.